CommitToWealth.com, creating a legacy by committing to real estate wealth.
Welcome back, everybody. This is the Commit to Wealth podcast, and I'm your host, Juan Vargas. On today's show, we have Nic Espanet. Nic is a multifamily investor and syndicator based out of Fort Worth, Texas. He has nearly 4 years of experience with multifamily, having been a passive investor in 7 separate deals, and a lead syndicator in 2 others, with another that he's currently working on. So, Nic, welcome to the show.
Hey, Juan, thanks for having me on your podcast. I appreciate it, and congratulations on all your success. Just a quick introduction. Like Juan said, I've been started passively investing in multifamily real estate about a little under 4 years ago, and have been passively invested in 7 deals, which totals 1,780 units. 2 of those have sold, so currently we have passively have 1,590 units total. So after about a year of passively investing and kind of learning the ropes and how it worked, I opted to start syndicating, and found a couple of partners. And within about a year, I was able to syndicate my first deal, which was 100 units in Abilene, Texas. That closed in February of 2018. And then a little bit later that year, in December of 2018, me and my same 2 partners closed on a 124-unit property, also in Abilene, approximately 5 miles from the original one, in a little more retail-centric area. So it's kind of moving up a grade of apartment. First one might have been a C or C minus. The second one I'd say C, C plus. Both of them were mid-70s build, and then we kept, after we got those kind of stabilized and running, we started underwriting a little bit more, and just the kind of the, like they say, once you get your first deal, it comes a little easier. I was at an Old Capital event, and the a broker approached me and some of the partners and asked if we would like to do a pre-release tour. And to be honest with you, at the time, I didn't even know what a pre-release tour was, but I said, sure, I'll be there. It sounded like something I wanted to be part of. So, and it was like not even a week later. So we all kind of cleared our schedule and went out, and we toured the property that we now have under contract, and really liked the asset. It was clean. Everything looked good. We didn't have financials at this point yet, because they didn't even have the OM together. And we told the brokers that, we said, if the financials look as good as the property does, we will definitely be making an offer. So we kind of got everything penciled together pretty quick, and made an offer, and it came through, and we're expected to close mid to late August on that property. So that's another 228 units in Abilene, which will put us at a total. So we have 124, and we're actually converting the maintenance shop at the 124 unit into an efficiency. So that'll go up to 125 units. And then with the 228, it'll put us at 453 units in Abilene, which has helped us scale with our, just the payroll and the maintenance staff that we can share between properties, and our property management fees have also come down with us scaling up in size out there.
Man, that's awesome. So let me back up a little bit. So this is going to be your 3rd deal. And you have been a passive investor in a few of the deals, 7 to be exact. So, what made you get into this business in the first place? You do have a business background, right? So, tell us maybe a little bit about your background and how real estate or multifamily got into the picture in the first place.
Okay. I initially started looking at real estate. My wife and I were looking for something more stable for our retirement funds. Other than the stock market, haven't seen it go up and down multiple times. I guess let me back up first. I'm a physical therapist. I got a master's degree in '96 in physical therapy. Worked in a hospital for about 10 years, and then started doing home health. Formed a little contract home health company where I oversee physical therapy assistants. And so, my initial putting my toe in the water for real estate was looking at single family, just something to where I could have my hands on more, unlike putting all my retirement stuff into mutual funds or whatnot and not really understanding it. I understood estate. I understood how to buy a house, and I'm kind of a hands-on guy. I wanted to get involved with it. And we actually had a life event. My oldest daughter, who's doing great now, was diagnosed with leukemia. So we put all that on hold for 2 or 3 years while she was on chemo for 2.5 years, just trying to get settled with that. We just, we had to focus on her health at that time. So then we came back and started looking again shortly after she was completed with her treatment. And I just kept coming across multifamily. I'm like, initially I was like, that's not something that an individual can do, or you think it's like being big corporate groups or funds. But I just kept seeing more and more about it. And I attended one mentorship group and was ready to go. But then my father-in-law brought up, he heard about another group on bigger pockets. And he said, I think you ought to go see this guy before it sound like a lot of good things about him. So we attended that seminar and it was great. Joined up. I think everybody should have some, either paid or you need a mentor. You need a team with you in this. So we joined that in early 2016, and then just started kind of learning and passively investing, and then after a year, I'm like, I feel like I know enough now that I can jump in a little more.
It's something that you have to do. Is you always have to have some kind of mentorship. You always got to have, like you said, either paid or not paid, but somebody that you can reach out to with any questions that you have. Because especially in the multifamily business, if you don't have that, then it's going to be a long day. You got to have that support system, so to speak. So let's go back to your deal. So you started investing in some multifamily deals. You started to I guess test the waters and see what the business was really about, see if it's real, see if you were able to actually cash flow from these deals, and which you were. That gave you the confidence to look into your own deals. So I want to talk about Abilene, because that's a market that you started looking into. That's the market where you have it'll be 3 deals by next month that you have in that market. Why Abilene? Why not go into a primary market? Primary markets are what we usually look for, because we try to think of like the exit. We try to think of the end buyer. There's going to be a buyer all the time in a primary market. The cap rates may be a little bit lower, but just because of the exit, you want to look at the whole overall picture. And whenever you think of a secondary or tertiary market, it's not something that you really think about. You may think that it's a little bit tougher to be in that market. It's a little bit tougher to scale. Maybe it's a little tougher to find quality people that want to be in that market or in a market similar to that. So what was the deal with Abilene? What did you find interesting about Abilene, and why did you choose to go there?
Okay, no, great question. We initially were looking, kind of started with the guys I was partnering with. We were like scattered everywhere. And then we finally decided, hey, we got to focus. Let's pick some markets. And we were looking in DFW. At the time, didn't have quite as much capital to come in with a, 2 or 300,000 non-refundable day one. So my business partner, Brad Abbott, and I started analyzing all the smaller secondary and tertiary markets in Texas. And we found that most of them still had positive job growth, positive population growth. It wasn't DFW job growth and population growth, but there's very few places in the U.S. or anywhere that have that strong of growth. But we still had a positive growth. So we just started focusing on West Texas, because we live on the west side of DFW and Fort Worth. So it's just part of that was for ease to get to, instead of having to drive to East Texas. And the concern with we did think about the concern. We're going to have a smaller purchaser pool when we do go to sell, but there's still going to be purchasers, and it is in Texas that that gave us. I wouldn't want to go buy in a smaller market in Oklahoma or Arizona or maybe even Louisiana, but with the positive job growth. So, and we did underwrite. We're using anywhere from 100 to 150 basis points higher on our reversion cap rate of a similar property that would, if we purchase it in DFW. So we are using a much more conservative reversion cap rate, and there is the challenge of you have a smaller employee pool, or when you're trying to hire maintenance guys, and Abilene is not in the oil and gas market, but it's right on the edge. Midland's only 2 or 3 hours away, so somebody that's has decent mechanical skills can go make a 6-figure income working in the oil on an oil rig versus working in an apartment for $40,000 or $50,000 if you're a good maintenance guy. So it has been a challenge, but we have worked through it. Our property management company has done well. We did have a challenge early on. We started with a property management company on our first property, and they struggled. They had 2 leasing agents, and both only lasted 4 weeks. And then a maintenance man that only lasted 4 weeks. We replaced them at 6 months of ownership. We really started the process around 3 months, but with having a Fannie loan, we have to get the lender's approval for any new property management company. So we started interviewing new property management companies approximately at month 3 of our ownership. And then by the time we got approval and everything lined up, it was 6 months. So it took close to 3 months to go through the process of replacing the property manager. And since our new property management company has taken over, they've done great. We had to replace one office manager or a leasing agent, but they had somebody in place right away. And so that is a piece of advice I'd like to give out is if you're buying, especially in a smaller market, make sure your property management company has at least one other asset in the submarket. Our first property management company, when we started talking to them, had another property in Abilene, but it sold, and they did. By the time we got our first deal there, they did not. So they did not have the contacts for contractors and just an employee pipeline, which the company we have now does. They've got now they have our 2 properties and two other properties there in Abilene. So once we get this next property, they'll have 5 properties there. So it allows them to share employees, or if somebody does leave, they can shift somebody over to cover instead of hiring a temp or trying to find a contractor just to fix a door, or some of those things that ought to be done quickly. They have other people on staff that can come over and help. So that was a big learning lesson, is make sure your property management company has another asset, in proximity, or at least within the submarket. I think there was one. So, why we picked Abilene, and back to it, positive job growth, proximity to the Metroplex. And I'm not big on oil and gas areas. There's a lot of stuff movement in Middle and Odessa, but they're very boom or bust, up and down. And Abilene, as we looked through it, had in the top 30 largest employers, there was no oil and gas employers in that level. So that gave us some comfort. Abilene does have Dyes Air Force Base, which is a big Air Force base, but we really dug into that, looking at the BRCA, or how the government closes bases, and found the metrics they use. Abilene was very favorable in those, especially one is they look at the relationship of the community with the base. And Abilene, the Air Force gives out an award every year to the community that best supports its local base. And Abilene won it so many years in a row that the Air Force asked them to withdraw from the running, and they named the trophy the Abilene Trophy. So Abilene has a great relationship. And then just earlier this year, Abilene was named one of 2 bases that will be supporting the new stealth bomber that's coming out. So it is the federal government, so they could put a lot of money into it and then leave, but most likely they're going to spend a lot of money retrofitting Dyes to I believe, for the maintenance and the training of the new stealth bomber there. So that should, 1, bring jobs, and 2, secure Dyes that's not being closed down in the future. Abilene's second biggest draw is it's a medical hub for 13 counties. Really, the MSA is only 3 counties, but they draw into their medical center, draws in from 13 counties. That's part of being in West Texas, where you have nothing around it. All those people have to come into Abilene for their health care.
Yeah, so just because it's a secondary market or tertiary market, as we mentioned, I mean, there's a lot of things that are, in your specific case with Abilene, there's a lot of positives that you're seeing as well. Some of the challenges that you faced, and I'm just kind of recapping, was more on the staffing side, right? So you had maintenance guys that were leaving. The management company didn't have necessarily another property that they were managing currently. So who was it that you're using now Is it a larger management company that has a bigger foothold in the market, or different markets, or who are you using?
Wayner Multifamily, I believe they have 20 or 22,000 units across Texas, Oklahoma, possibly Louisiana. I'm not sure what all states they're in, but I think they're very DFW and North Texas centric. They may be moving into Houston, but I'm not 100% on that. They've done great, and they had they've already having 2 properties out there helped a lot, and then they're based out of Dallas, so we've been able to be in contact with them. Actually, have a meeting set up tomorrow for our new property. Me and one of the other asset managers are going to meet at their office with their team and kind of get our plan together. So when we take over in mid to late August, everybody's on the same page as so we can hit the ground running.
Right. So what other challenges have you faced, because you went to, and I'm not trying to knock on a secondary market or tertiary market at all, because I think they're actually good from a cash flow perspective, versus other like primary markets. I actually like, secondary, tertiary markets. And as a matter of fact, I even invested in one of your deals, right? So that even told you that, so I invested in one of your deals in Abilene, right? So, I just want the audience to kind of, get the pros and get the cons, both, whenever you're investing, you're looking for deals for your own, or you're looking to invest in deals that are in secondary, tertiary markets. So what other challenges have you faced, besides maybe the staffing and, the maintenance guy, have you thought of anything else that maybe you have encountered that you maybe thought that you wouldn't have, came across if you were like in a primary market?
I think we'll see when, at sell, maybe a little challenge just because, anybody will buy. Let's see, in DFW, you've got maybe 4-fold more people who are willing to buy. And we've had a couple investors that did not want to, they said, I won't buy anything or invest in anything outside of DFW. And, that's fine. And they have that option. But, so I think we will have a limited buyer pool. But I don't think it's going to be, it won't be zero. There will be somebody. We had in each one of our deals, we got in a best and final. So we had multiple offers. And I think as more people realize Texas is great, and, I hear some of the lending brokers and an economist saying that these secondary markets are great places, like you said, for cash flow. Our biggest challenges is really staffing. It is, we do have a smaller pool of tenants, but at the same time, a company could move into Abilene or Amarillo or Longview, somewhere in East Texas. Somebody that only employs 100 units moves the needle a lot. If a company that employs 100, not 100 units, somebody that employs 100 employees moves into DFW, may not even make the newspaper barely. But in Abilene, that would be a massive, or any of these small markets that, Abilene is about between 120, 125,000 in the city, and then the MSA is around over 150. So, bringing in 100 employees is going to really affect. At the same time, you could have if somebody leaves, but a company that surprised me that would move from California to Abilene. Now, this is before we started marketing. And I may not pronounce it right, but Taiga Boats. They make the high end wakeboard boats, but they moved from California to Abilene, and they're based out of there. So Abilene is very aggressive and proactive on recruiting business. They formed a committee, I don't know if that's what you call it, in the 80s after one of the 80s oil crashes, and said we need to focus on getting other business. So they were really proactive in trying to not be dependent on oil and gas, unlike some of the other West Texas communities that are, they live and die by the price of a barrel of oil, and these guys don't. So I can't really think of any other significant challenges other than the staffing and so we'll see what ourselves. We did use, like I said, less, when you're analyzing deals and you're looking at a nice property and you want to use a more aggressive cap rate, but I can say is a little frustrating, but at the same time, we got to know it's reality. We're not going to have the demand in Abilene or Amarillo, Lubbock, some people are buying in El Paso, to push that cap rate down like you do in DFW or maybe even Houston, San Antonio also.
Right. So the only way that you can, the best way to mitigate that is just to make sure that you account for a higher cap rate on the exit. right? So
Definitely.
if you account for that and the numbers still work, then you should be golden. Just make sure that you have the right team to work with, the right management company to oversee your asset, and have a good business plan, and you should be good to go. So let's talk about your investment criteria then. So if you are looking for deals, say in a market like that, then what is the minimum that you're looking for to be able to go there, right? Because you're based out of Fort Worth. That's about 2-hour drive or so, 2.5-hour drive, something like that. So what is your minimum criteria to be able to look at a deal that say you want to look at a deal in Abilene?
100 units. We're looking, maybe $5 million and up. We started out, it was just Brad Abbott, Dustin Miles, and myself. And as we grew, we were finding Brad and I still have day jobs that we were, if we wanted to continue to grow, we needed to bring in some more teammates because we didn't feel like we could analyze deals and still manage our existing properties. So we ended up bringing in 2 more partners, Nic Espanet and David Spina. And they're helping. That gives us, so we can kind of keep our pipeline going. So we having 5 members. I mean, just when you sit down and look at it, a 100-unit property or $5-7 million property, there's not much of the pie to split up. There still is, but it takes, as it takes as much work to do a 100-unit property as it does a 200 or 300 unit. There's not a whole lot of difference in the purchase and that. So we have started expanding our criteria some for bigger. Just so there's more to go around, but not to say we wouldn't buy something in that 100 unit, but I definitely wouldn't want to get any smaller than that because then you don't have property management. Third-party property management doesn't really scale up for that. We're looking we've got Brad Abbott came up with a chart that shows the job growth, and he took I think 8 different metrics that he found from different analyzing websites that show the livability, and not really livability, but job growth, population growth, employment, and some things like that. We kind of made a scorecard of all the secondary markets. I don't think we'd do anything in a community that was less than 100,000. Possibly if it looked really well. There are some of those even smaller. I don't know if you'd call them smaller than the tertiary markets that are doing well. That have growth. We looked at something in Cleburne earlier this year, but that's really still part of the DFW. It's down the tollway, but it's, I believe, only 30,000 people live there. But they just opened up a tollway going down to Cleburne and in that area. So positive job growth, positive population. That it's not one company dependent or one employer dependent. If 50% of the people in the population are dependent on one employer, that can go away real quick. We're looking now at starting to move up in more stabilized properties, although we have started kind of brainstorming on what it would look like to take over a struggling property and something that you may not be able to get a Fannie or Freddie. And, I don't know that we're going to do it, but we're just kind of looking at all our different options as the market tightens up with more and more people coming in to buy. I think it's important to at least look at other possibilities on how, a different way to skin the cat, so to speak. Just to, maybe if it's in a good demographic, if the 1 mile radius occupancy is good in that area and, but this property is struggling for some reason, and we can go back and look at the historicals and it has had good occupancy, would it be worth, taking a look at and doing something where you have a bridge loan and then being able to refinance it or sell it in within 2 years of stabilizing it?
Yeah, some of those non-stabilized deals, can be definitely worth it. And everybody has different criteria. Everybody is gonna, you're gonna have people that like those kind of deals. You're gonna have people that don't like those kind of deals because there is a little bit more risk. But with that little bit more risk, there's more upside too. So there's definitely that. So how are you structuring your deals? What's a typical structure for you and your limited partners, your past investors? How does that work? What kind of returns are your investors looking for on a specific deal?
Being in a secondary market, well, first of all, we've been structuring anywhere. Our first deal, we took a 10% sponsor fee, which isn't much, but it's getting your first deal. Brad Abbott and I opted. It's like, hey, we need to get our foot in the door. So it's we're making a little bit of money off of it, but not a ton. And then the next deal we did 17%. And this our current deal, we're doing 15. We were up to 20, but we just some things changed, and to make the deal work and to be able to get the returns to our passive or limited partners wanted, we lowered our sponsor fee from 20 down to 15. We fill out in Abilene or the secondary markets. It's important. We want to get we're shooting for over 12% annual cash flow to the investor, because we feel competing with if we had a similar deal, somebody was on the market at the same time in DFW, they would which might have 9, if we were underwriting, we'd be okay with maybe 9 or 10% cash flow, but just because some people's hesitancy and not being familiar with Abilene, we want to get over a 12%. We could have done it. We could have kept our sponsor fee at 20% and given it, I think, 9 or 10% cash flow to the investors, but we just felt to compete with deals in DFW or Houston, San Antonio, we needed to have a higher cash flow. Now, our current deal is it's going to be a little over 75% total return to investors in 5 years. So most of this returns are coming from cash flow, which that cash flow is more predictable than the sale, because with the sale we're using a reversion cap rate, which is that's 5 years down the road or more whenever we opt to sell. So that's that's using a little more of a crystal ball, whereas your cash flow is in place. And we stress test our deal a little bit. If we didn't show any increase in rents or any increase in income from the T3 to year one, we still have between 7 and 8% cash flow. So if we're in a primary market, we would use 9-10% cash flow. Secondary market, we want to get at least we've been sitting at 12. Anything over 12 would be optimal, just because we feel we need that to overcome deals that are in the primary markets. And so I guess, and then within our sponsorship group, we've got that. 3 of us on our current deal. 3 of us are going to split the asset management and work on that. One of our partners is he said he would do the asset management if we wanted him to, but he's more with investor relations. So he didn't want to cut of that, and it's Dustin Miles, and he has a lot. This is his 10th syndication that he's been part of, so he's there if we need him. We can get on the phone with him or a text. In fact, I probably talk to him almost every day on the phone, at least every weekday for a few minutes. So if we come across something that one of us less experienced guys haven't handled in the past, Dustin has always been very responsive on the phone. So we have him as a backup, and that's kind of how we structure that. And then we split the sponsor fee amongst us.
So just a quick recap. So you are doing, less than what most people out there do. So I think like the standard out there that we have seen is more of like the 70-30, 75-25, maybe even 80-20, something like that. But, you wanted to make sure that you are taking care of your investors first and foremost. And even in your last specific deal, you had it originally higher, but then you lowered it just to make sure that you're also competitive, with other deals that are going on for that passive investor are looking at. So maybe a deal like, as you mentioned, your example was DFW. So if we're passive investors and we're looking for deals and that they want to invest in, and we find a deal that is maybe projected to be around 8 or 9% cash on cash, but then you have a deal in maybe in Abilene that's also 8 or 9% cash on cash. Well, most people are going to go with the DFW deal, right? Just because it's a primary market, they may feel a little bit more comfortable with that. But then all of a sudden you change it, and then now we're talking about 12 or 13%. So it's way more attractive now, right? So that's one of the things that it gives you that competitive advantage as well. So the other thing that I want to talk about was the fact that your returns, right? And this is, I think, is very, very important for everybody listening to pay attention here with this specific point. This is something that he mentioned, and I think is very important and is key, really, because whenever you are looking at deals, and I'm thinking about it from a passive investor standpoint, but also those of you guys looking at the takedown deals, think of what you had to do to present it to your passive investors. So one of the things he said was on the returns standpoint. So he said it was like a 75% return on this current deal that he's working on. But what was the cash flow, right? So the majority of that was coming from cash flow, right? Because it's easier to predict cash flow. It's easier to manage your deal and know where your cash flow is going to be at, versus looking at the reversion cap and then maybe lowering your reversion cap, and then now all of a sudden now you're at 120% return, right? So it's so easy to change your reversion cap is my point. And you really cannot count on that. You really cannot. You wouldn't have a crystal ball to know what's going to happen in the market 5 years from now, right? The market always dictates what is going to happen, and it's so much easier for you to control the cash flow, and so it's so much better for your returns, or the majority of returns, to come from cash flow. Maybe 50-50, something like that, or higher from cash flow. So that's something really, really specific, something really, really important, that for those of you that are newer, that are looking at deals, pay attention to that whenever the next deal that you come across that you're thinking about maybe investing in. Think about that, look at it, compare it, and do your math. So yeah,
Yep.
Thank you for sharing that, Nick. That was very important. That was very key. I think more people need to know about that. More people need to think about that whenever they're looking at deals.
Like you said, the reversion cap rate, just a 50 basis points drop in it, on your analyzer, can make your returns just skyrocket. It may give you, 10 or 20% on your total returns with just a slight change in your, as you know. So yeah, the cash on cash needs to at least be 50%. That's definitely what I don't think we would ever market a deal or go through with a deal if we couldn't get the cash flow at least 50+% of the returns.
Great point. Yeah, I love that. So, Nick, it is time for our Nuggets of Wealth. And these are questions that I ask every guest every week, and hopefully they are able to help the audience out. So question number one is, what is a good tool, source, or platform that you use almost daily that can also help others?
Mailchimp, everybody's pretty familiar with that. We actually started DocuSign on this last syndication we're doing, and that it was a challenge at first. It took us about 4 versions to finally get the documents correct. So that I think we've worked through it. Next time will be much easier. But one that may be less known, that I don't necessarily use it every day, but it's called Able to Extract. So it's ABLE number 2 extract, and it is an app that allows you to convert a PDF or a Word document or something like that into Excel. I used several free ones online, but they were not. It's user friendly. The Able to Extract has been when we're first getting financials and they're in a PDF form and not in Excel, trying to check thing or make a T3 out of the T12 is a challenge. So that Able to Extract, and I want to say I bought it probably 2-3 years ago, and it was $180. But it's been and I think that renews automatically every year, and it may be a little less, but it's that has been a great app. One of the things that makes it a lot easier, because I think the very first financials or rent roll that I had it printed them out, and I had a different color highlighter for every floor plan, trying to so I could just differentiate what was on it. But now I can take a rent roll and put it into Excel, sort it by floor plan or unit mix, and then I'll take that and I'll make a tab for each unit, each floor plan, and then I can sort it and see what they're getting by how much the rent, what you can then sort that by date or by highest rent to lowest rent or something like that, and try to look what the rents they've actually in place achieved in the last 3 or 4 months. If a rent was 11 months ago, that's great, but it's you really want to look at those rents that have been in the last 2 to 4 months. What they've been getting recently is a better predictor of what you make, what your starting point is, and what you might be able to achieve. So being able to get it into an Excel has been just invaluable.
Gotcha. So that is able to extract.com.
Yeah.
Okay, we need to check that out.
So the 2 is the number 2, but the other are letters. And watch out, because there are a lot of kind of knockoffs that try to find the original source of it.
Yeah, just go to the website, right? Able to extract.
Sure.
So, Nick, what was the best business advice you ever received?
Best business advice. Rich Dad, Poor Dad, that's a whole book. That was great. But one thing, I had a challenge with analysis paralysis at one point. So, our mentor has a shirt that says "Ready, Fire, Aim," And if you're into shooting sports, that's not necessarily the best advice, but for, at some point you just got to get off the bench and take the shot. So I like that ready, fire, aim. You definitely want to do your analysis, and you don't want to just be firing willy nilly, but you got to do something. Take massive action. I think that's a Tony Robbins thing. Once you decide to go in, hustle and full force, and that's a great thing about having a mentor and being involved with a mentorship program. They're going to help you work through problems. Each one of our deals have had challenges pop up, and sleepless nights at time. You're like, oh my goodness, what are we going to do? And every one of them have worked out. But it's having a team, be it your mentor or somebody that's within the lateral system of the mentorship program, that you can call on other guys or girls that have been through this before and run the problem by them. So, that pops up another one. Success leaves clues. So, find somebody that's done it and work with them. Either as a partner or a mentor of some sort.
Okay. What book are you currently reading?
I just finished yesterday. Was it called Go Getter? I just went blank on the name of it. Let me pull it up on. But I also a week or two ago finished the Millionaire Fast Lane. That was a great book by MJ Demarco that I really liked. That was just talking about wealth and how the world thinks about wealth, and how we and how your mindset of money. It was a great book, MJ Demarco. But the one I just finished was The Go Giver. It's a very, very short book. It's by Bob Berg and John David Mann. I do most of my books on audiobooks, so it's when I'm driving, I've gotten to where I haven't listened to talk radio in probably a year or more. Just one, it keeps my blood pressure down. But I'm either listening to a podcast or some kind of a self-improvement, self-help book. Be it real estate. I try to throw in a parenting book. With anything you do in life, you think you need to find. It comes back to a mentor. Be it a book, a class, or something like that. So and what. Maybe 3 or 4 times a year, I'll throw in a fiction book just to try, or a classic just to mix it up a little bit.
Good. Where do you see your business in the next 5 years?
Just in the last 3 years, it's been amazing what I've been able to accomplish, or 3.5, 4 years, accomplish with, as we started investing, I'm come very close to replacing my day job income. I'm blessed that what I'm doing now is 1099, so I can work 10 hours a day, or I can work 0, to kind of scale up and down with how stuff's going with real estate. In 5 years, I would like to see me, more than doubling the portfolio, being able to spend more time with a family. And, that's why I started getting into this more. The why is being able to have the free time to spend time with my wife and children, travel, be able to travel to different places around the world without really, obviously want to have a budget, but not having to, no, we can't eat there because it's going to blow the budget up. Just little things like that have, kind of been, restricting on when we're traveling and where we can stay, and just, to create experiences for my children while they're still at home, in memories. So, business-wise, that would be, having another, acquiring, up to, 400 or 500 units a year, and going, and some of them will go full cycle, but then having a system in place that I could step away for a month, and you still have checks coming in, and you have a team that, they may need to catch you on the phone every once in a while, but right now I trade time for dollars, and I want to be able to shift some of that time away. And, I know multifamily is I don't have the a vision that I'm going to be able to sit on the beach 24 hours a day, 365 days a year. I know it's still, but as you can really hustle for a few weeks to months, and then you can have some little lulls too. So just to be able to enjoy those lulls. And
right. Yeah. It's just to to be able to do what you want, when you want, kind of, and where you're not restricted to what you can or cannot do, and just the freedom, right? So, last question: at the end of your life, how do you want to be remembered?
Well, as I'm expiring, I don't want to say I wish I would have done A, B, or C. That's for sure. But then, if I guess first of all, as a good husband and father, would be my biggest goals. A lot of goals to build business, but ultimately, my wife and kids need to be my first goals, and I think the business is going to supply that. Or the real estate, but that I served my family well. I guess if I had to put it in a brief little statement, because if I've served them well, I think I'll serve a whole lot of other people well too.
Love that answer. So, Nic, where can Commit to Wealth Nation go to contact you and find out more about what you're doing? Maybe they want to reach out to you. What's a good contact?
Okay. My email is Nic, Nic, at Thrive Multifamily. So that's THRIVE Multifamily. And then if you want to give me a call or a text, my phone number is 817-683-8114. I'd love to sit down and chat with anybody that has any multifamily questions or wants to hear more about how our journey is. We've gone through our journey. Best way is probably to text me. And then let me know your phone number and that you, and then or send an email. I try to get back to all emails within a day. So I'd love to hear from your listeners, and thank you very much for having me on, Juan. I appreciate it. And I think we've probably known each other a couple of years, but I think I met you in Hearst the first time. And love to see what you've grown in, what you're doing too, man. Congratulations.
Yeah. Hey, thank you so much for everything. Thank you so much for all the information that you shared with us here today. You gave us a lot of information, a lot of value. So really do appreciate that, Nic. And I wish you continued success.
I appreciate it, Juan. Thanks for having me on. Have a great day.
CommitToWealth.com. Creating a legacy by committing to real estate wealth.